decisions, because I'm one of my very best friends. He probably is going to listen to this episode, so I won't say his name. I mean, he's missed out on this market since when President Obama was elected. Which is really insane. So I think you bring up a good point. And so, sticking slightly on this political topic, with the election looming in November of next year, less than a year away, any sense of how that might affect the market and or the economy as we move into 2020?
I think the key is going to be actually corporate profit. And I think I was doing some homework, and the forecast for corporate profits is up in 2020. And I think if you're talking about economic factors, the forecast for corporate profits is up because of economic factors. And I would make decisions on that rather than a political who's going to win and who's not going to win, and is he going to get impeached or is he going to get impeached? So just, I definitely think that if all the wise brains are forecasting corporate profits, they're projecting a 3.4% increase in 2020. That's pretty significant. So I would stick with that.
And if we get that type of corporate profitability increase, that certainly postpones the risk of a recession, which you and I are in agreement. And it also is a hint that maybe the market won't have a big sell-off next year. Of course, I would not take that to the bank. We're not guaranteeing that or nothing of the sort. But the health of the U.S. corporation, by and large, is another backbone of the market's move upward and the economy in general, because it seems to me that U.S. profits are healthy, but also the U.S. is really competitive against their global competition. Seems like most big U.S. corporations are well positioned to win business around the world. You agree with that?
And the other thing, and the other thing that's important is interest rates. Our interest rates are historically low, but they're much lower globally. So we have an attractive interest rate structure, and they're projecting that the Federal Reserve seems to be cooperating with the whole idea of supporting, economic growth of no projected increases for all of 2020. And now they may change their mind, but that's the latest. So if you have a low interest rate environment, that's definitely a plus for businesses. That's the cost of investing in new tools and new ideas. The lower the interest rate, it's like an accelerator in a car. You're pushing the accelerator down when you keep interest rates low.
So we talked about a wide-ranging list of things so far. China, corporate profits, interest rates, a little bit of the looming election. I don't think we could talk about the economy and the markets without touching on this really impressive jobs market we have in the U.S. So can you touch on that and how that's affected things in 2019 and what we might see in 2020?
Well, the employment forecast in results is a positive. More people are employed now than have ever been employed. And that's because, again, interest rates are low. The U.S. economy is doing well. So I think you can create as many jobs as you can before the next election. I mean, he stated that's what his goal is. So I just think that the outlook for jobs is great. I don't see any problems at all there. I think it's going to be a stimulus rather than anything else.
Sure. I mean, and for the first time in U.S. history, and this has been going on for a little bit, is you have more job openings in this country than people looking for jobs. And, that is the sign. I mean, to me, that's an unmistakable sign of a powerful economy that's not ready to roll over. And you're also starting to see wage gains. So over the last couple of years, the bottom 50% of earners in the U.S. have actually seen their incomes increase faster than the top 50%. And that's a trend change over the last couple of decades where, not to sound like a politician, but the rich got richer and Main Street Americans fell farther behind. it's not that we've changed that all that happened over the last 10 or 20 years, but over this last period of time, we've seen the trend change. And Dean, you probably know this, but one of my favorite overlooked statistics is that for 16 months in a row, U.S. wages have increased 3% or more. So that's 16 consecutive months. Now, sometimes when you'll hear talking heads in the media, they'll still talk about how the average American worker hasn't gotten a raise in 20 years. And that's true. It's very true. But that's not really the key thing that's going on today, because we can't go back and address what happened in 2004, 2006. But the trend now with this positive job market situation is that we are seeing wage increases, which we've long sought, and we're now beginning to see a trend change, and that's a pretty good 16-month record. What do you think about that?
No, I totally agree. I mean, I really don't see any negative signs there at all.
So what do you think about some of the negative things? Because going into the fourth quarter of 2018, a lot of people, including me and our team here, we didn't anticipate as brutal a sell-off as we had in the fourth quarter. Downturns come and go. They're normal. Go with the territory, roll with the punches kind of thing. But, I mean, it was particularly brutal, especially December. So what do you think about bubbles? What's wrecked the market and the economy over the last 20 years has been nice run-ups, periods of growth when everything seems really good. Then you had bubbles kind of wreck things and undo a lot of what was gained before then. You had the tech wreck, the financial crisis, you had the Bitcoin run-up only to blow up. You have lots of different bubbles that have burst over the last 20 years. Do you see signs of bubbles anywhere?
Well, no, I don't. I don't want to seem too positive, because that's a dangerous thing. You always have to have your, be wary. One of the things that people, I think, forget is that one of the reasons the U.S. is doing so well is that the rest of the world isn't doing very well at all. So what basically could occur, which is kind of reverse thinking, if the world economy does better, the U.S. economy might not do as well. So, depending upon whether Brexit actually works or whether this, China thing does not stabilize, if we go to war with North Korea, let's just say socialistic European countries, that could create problems. All those things can occur. But I think that's why it's more important than ever to have a good advisor like yourself. I'm not going to sell you, but it's true, to watch all of these things, because it's going to change. And the other thing is, if you need income, how do you create income when the bond yields are so low? You need an advisor to help you get the income that you need. You can't just buy. When I first get into business, the life expectancy after retirement was 5 years. And the great strategy was sell all your equities, buy bonds, and by the time you run out of money, you're going to be dead. You can't do that anymore. So you do need, an advisor that's going to take the time to do that. That's why you get paid, Chris, as far as I'm concerned. With algorithmic trading, you're going to have all these wizards, buying and selling stocks with fractions of a second with results. But that's not going to solve your problem. So, yeah, there's a lot of things that could go on, but that's what you get paid to do. You watch it, and they have fun doing whatever they're doing.
Sure. I mean, a market correction, which I think over the history since World War II happens every 1.87 years, by that measurement, we might be due for one in 2020. But in terms of bubbles, and part of it is I just read a research piece by one of my favorite economists, John Malden, who's become very pessimistic, and he was talking about the bubble of Federal Reserve or central bank bubbles. But I really don't see it. You don't see it really in real estate. Real estate, commercial and residential, in general, calmed down this year. I know the stock market has run up, so people sometimes think that's a bubble. but it's run up because corporate profits have run up. So it's really not that expensive on a price-to-earns ratio based on history. It's not inexpensive, but it's not crazy expensive either. It's gone up because profits have gone up, and that makes sense. That's right out of your basic finance textbook. So I really don't see much in the way of bubbles. A correction might happen, and political turmoil could play into that. There's still geopolitical risk with North Korea and other bad actors on the world stage. And the China thing, which as of this recording seems to have kind of been tamed for the time being, that certainly could become a more sensitive issue as the two countries continue to negotiate hard. And that could create a bit of a market sell-off, although I think I would be a buyer into that sell-off, candidly, because I think long-term, the U.S. will get a good deal with China, and China needs us more than we need them, although it's better if we work together. So I don't really know, and you said something earlier that I think was really wise. You got to be careful not to be too positive, right?
You have to rely on someone like yourself who's watching it, because the news can change on a daily basis. You heard good news about the China tariff situation, the stock market went up. Next day, no, it didn't go up and the market went down. So you got to have someone who's watching it to judge, well, then that's what you get paid to do. I don't really do that much anymore. I'm looking at the big picture, right, and that's why I sold my business to you, because I trust you and I think you're going to do a good job for the clients.
Beautiful. Well, Dean, thanks so much. This was a great discussion. We'll do more of these because listeners really appreciate it. But at the very least, maybe we could do it again mid-year, like we did mid-year 2019, and check in with one another, sometime in July. Is that all right?
Sure. And if one of these bubbles occurs, let's get on the line and talk about it so people don't do the wrong thing and sell when they shouldn't, or buy when they shouldn't. It's when bad news occurs, it's good to get in touch with your advisor one way or another. And this is a good way for you to get in touch with a lot of people at one time.
Very good. So listeners, if you want more information about me and the rest of the team at Elliott Wealth Management Services, please go to our website, www.elliottwealth.com. We offer a complimentary consultation. If you're not a client already and would like to discuss your financial goals with us, we would love to do that. So take advantage. Also, if you haven't subscribed to the Simply Financial podcast yet, please do so. I would appreciate that a great deal. I will be back with you on the next episode of the Simply Financial podcast very soon. Thanks for listening today.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.
Simply Financial is part of the Exvadio Podcast Network. You can find Exvadio podcasts at exvadio.com/podcast, the Apple Podcasts app, iTunes Store, iHeartRadio app, Spotify, Stitcher, and wherever you find podcasts. So join us and stay informed and entertained.